Stanford University.
So this is Trish Costello. She's the founder of the Kaufman Fellows program. So just imagine, since she's founded the firm, founded the program, there's been 400 fellows,
Yes.
Over 40 countries represented, as well as about $200 billion deployed in capital. So there's a number of fellows at the VC firms on Sand Hill, including some of the founding partners of those VC firms. She's also been on the startup team of the Kaufman Foundation, and she led the women's initiatives there, as along with topics around angel investing, venture capital, and whatnot. And aside from that, she's also the founder of a company herself called Portfolia, which is an investor platform for startups. And she's also on a number of advisory boards and committees ranging from the National Venture Capital Association to National Science Foundation and a number of other committees. So we're really excited to have Trish here. She's kind of I like to consider her the godmother of a lot of VCs here in the Valley. So we're going to have a casual fireside chat conversation and really dive into some topics around venture capital, angel investing, as well as equity crowdfunding platforms.
Yes. Thank you, Ernestine. Well, it is wonderful to be here with you. I've really been looking forward to it because it gives me an opportunity to test out a number of different ideas and thoughts that I have about where we are right now in the entrepreneurship and venture capital world. So I'm going to hit on kind of 5 general themes and invite you to jump in at any level that you would like as I'm talking, or if you want to wait till the end. It's really whatever works for you, because I want to make sure that this is valuable for you. And then I think I have an interesting exercise to do as we go along, and I'll talk a little bit about that as we move forward. So I did have an opportunity to look at a couple of the other presentations that you've had through the semester, and I think we're getting pretty close to the end of the semester now, right? So, so there were some really great speakers there, and as I was looking through it, I didn't look through the whole thing. I didn't have enough time for that, but I think you've had a really excellent opportunity to see what venture capital itself looks like today, from the standpoint of fundraising as an entrepreneur. What I see is that I think we're getting ready to go through a major renaissance in the venture capital world. In fact, I'll even step back and say I think we're getting ready to go through a major disruption in how you, as entrepreneurs, are able to fundraise your companies, and how venture writ large will be operating over the next 10 years and longer. And I would even say at this point that we'll look back 10 years from now at this time, right now in the development of venture finance, and we'll think of it almost in the same way that we do when we look back and say, my God, really there were 3 television channels. You would get your media from ABC, NBC, CBS, and the people that ran those networks basically were the arbiters of everything to do with media. And so and we look at that and we think, how quaint, actually that the whole country would be run and operated, and our mindset would be presented to us almost in the way that those 3 mega media corporations operated. I think that that's the kind of space that we're at now, where we're just getting ready to see this huge shift. So one of your speakers mentioned that really there's only 20 VCs out of this universe of 500 that actually make money, or actually doing the kind of venture that we think of as Silicon Valley VC. And I believe he's absolutely right. I think it's that small of a number. But think a little bit about what that means, that 20 firms have, and the partners in those firms have that level of control, that they are, that few of numbers are the ones that are blessing the startup world. And the models and the views and the patterns that they're looking at are basically what define venture capital for us across the country, if not the world. Because venture capital Silicon Valley model is the model for the world. Now, I always tell people they should not use a Silicon Valley model, that it's really very specific to Silicon Valley. But this is the model that we all look at. And so if we look at every other space, let's look at retail, media, music, you name it. Every other space has been disrupted and changed by the digital world, by a new transparent view, by collaborative connections, every other space. Now, the latest ones, the ones that were the laggards, have been education, health, and finance. And why is that? They're regulated. Want to jump in?
No, that's
Yeah,
exactly what I was
yeah. I mean, they're regulated. And when we look at entrepreneurial finance, it's held in a little tiny little private group with a lot of wealth. And so it's regulated, it's a small group, it is a high level of expertise. And so these are the last three areas, health and education. Now, about 10 years ago, it really got started. And now what we're seeing in really financing companies, actually the change started probably about 10 years ago. But what we're seeing now are some major shifts. And when we talk about crowdfunding itself is imperfect catch-all phrase. And I think of it as that way. It's almost like 3D printing. It is, it's kind of an odd, unusual way to describe a process. Crowdfunding, in a way, at this point, is so broadly viewed or defined by people that it almost doesn't have any meaning at all. I mean, it's Kickstarter. It is, GoFundMe. It is SoFi. It is AngelList. It is, Indiegogo, it's Portfolia. It's just so broad it doesn't really mean a lot. But collectively, all of these different things, Lenders Club and all of them, are massively shifting our ability to fund our companies. And what we're moving to now is basically a bespoke opportunity, where when you're looking at funding your company now, actually there's so many ways. And in the future, it's going to be that you're going to customize and personalize an approach, and it will be layered different ways that you're looking at funding your company. And you'll shift it and change it, almost like when you look at financing models within the bigger corporate world, where they're looking at all these different ways that they're putting finance in, depending on what it is that they're backing. That's what we're getting ready to move to in the entrepreneurial finance world. Massive, massive shifts. So that's why I say when I started that what you've seen so far is best practice, best of class of venture capitalists, talking about how they evaluate and what they're doing. And those people are going to be best of class venture capitalists in 10 years, 15 years, 20 years. We still have the New York Times. We still have The Guardian. We still have newspapers that are best of class, although there are 1,000 different ways now that we get news. And that's going to be the same with best of class VCs, but you are going to see multiple successful and complex and some simpler ways that you're going to be fundraising. So, and what I'm going to ask you to do as we talk about this and kind of go through this is think about how you now and in the next few years could actually expand your view of how you're financing your companies, and also how you would think about this if you were in the venture side as well, how you would be responding to this, because this will be disruptive. And those other 480 firms out there that aren't making money, many of them will go away, or they will transition into other types of services and approaches and service providers as we move forward. So let's look at what the state of play is right now in a number of the different ways that financing has changed. So just in the last year, let's see, maybe 18 months now, and I'm not going to jump into a lot of the details on this unless you want me to go there. So I'm going to leave this up to you on this. Because historically, we're now seeing major historical changes that are happening in regulations. We are seeing huge changes in how people want to collaborate and what information is out there. So it's 80-year-old laws that are changing radically. Up until now, you could only do a private solicitation. That's been the rule since 1933. And that's what all of us that have fundraised over the last, 20 years have done, private solicitations. You can connect and interact with people that are wealthy or accredited. On the angel side, VCs have a carve out from the regulations, but it's basically private ways that we interact and fundraise. All of that now has started to shift. Now, what I'm going to tell you is, if you have an attorney, are any of you attorneys? All right, okay. If you have an attorney that is not looking creatively at how you can finance your company, you need to fire that attorney. Because things are shifting dramatically. And you want to be able to have all of the quivers all the arrows in your quiver that you can possibly use as you move forward. And there are a number of attorneys that are very aggressively looking at opportunities. And there are others that are really, really holding back and to be very conservative. So I would say, from the standpoint, because this is not something that, even if we talk about, that you're going to be able to rely on anything I say as a non-lawyer on how to move forward. But I'm going to give you a picture of where we're at right now. But you want to make sure that your attorneys, your business attorneys, are giving you the right kind of advice that keeps you on the cutting edge. And at the same time, they're protecting you. So AngelList. AngelList has made a huge shift in how we think. $100 million in the past year. Venture money has gone out through AngelList. They're just scratching the surface. Is AngelList going to be the Uber of this world, or where they dramatically change everything and they're the big player? Are they going to be Airbnb? Are they going to be Craigslist, where they're the ones that shift and basically in some ways destroy the model for others, but there are hundreds, if not thousands, of other companies that basically burst through and are birthed by AngelList in the view of a Craigslist. I actually think it's probably closer to that view. I don't think AngelList is going to be the only player. Like we see, I think what they're going to do is birth hundreds of specialty players and infrastructure and ecosystem like we have no idea really to be able to define at this point. I think you're going to see massive structural changes. Things like the secondary markets. Before there was the roll-up that ended up with the New York Stock Exchange and the NASDAQ and others, there were literally dozens and dozens of exchanges. So for those of you that are into the history of that, it's really not, something that I can go too far into depth about, but there was wide variety, and we're going to be going back to that, where we're going to see all kinds of special secondaries, where the issue of, being trapped with lots of paper wealth and no way to get out and totally controlled by our venture partners, those days are getting ready to shift. They're already shifting with some of the new things that we're seeing come out. So let me just hit that. So we have 506B. That's what we think of as private solicitation. That's out there. Companies that are on AngelList or on Portfolia that can't actively advertise yet are 506B. Those have been around, for many years. You have 506C, often called accredited crowdfunding. That is being able to publicly advertise in almost any way, as long as it's honest and truthful, to the public and let them know that you're raising money. So when you see things that are online, fundraising on AngelList, those are 506C.
So a lot of the VC people who've come here have had a different mindset of that their entrepreneurs aren't trapped by the VCs, but are rather boosted into the skies by the VCs. What do you think about that? Do entrepreneurs starting their first company need the guidance of VCs?
Oh, well, see, and let me say, when I was saying trapped, I was talking about trapped with your stock. Yes. So you have no secondary to be able to sell. Right. Oftentimes you have to get the approval. of your investors to sell off any of your stock. And so, so you can be, as you know, really, really wealthy on paper and have very little, access to the cash.
That go to VCs for angel funds are in a better position than?
So I think it has everything to do with your company. And that's why I think that the idea of customized bespoke operations are so important. Because right now it's one size fits all. But great VCs are like any other great profession. The best of the best are incomparable as a resource than anybody else out there. They are, without question, if you can get them in at the right price and at the right time. So when you're saying as an angel investor, no. But when it's the right time, when you're ready to scale, when everything is, when you know what the scaling plan is, having the right VCs behind you are absolutely perfect. My own company, Portfolia, and as Ernestine mentioned, I have arguably one of the best contact files out there in the venture capital world. Yet for the first 19 months of my company, I have gone completely with angel money and kept it really, really low. Really low. And I do have a couple of people that are angels that are VCs acting as angels, who are good advisors to me. But I know what happens with a company and how much you have of it left if you go to the VCs too early. Even if they're my friends, they have a style and approach and a goal, and we know all about this. We know there's companies, I won't name them right now, but are multi-billion-dollar companies, and the founders have a pittance left because of how early they went. Now, if you're very young and you're doing that and you think you have 2 or 3 or 4 companies in you, that's quite all right. It's a great learning experience, and certainly it's makes you famous as well. But there's the majority of people, even in big wins, majority of the founders have very little left. So you have to be very careful about your timing. So that's why when I look at this, I think it's so important to know about when to go and how to do this. And will it be more complex? Yes, it will be more complex. Will you end up having, I think, by personalizing, customizing, creating a bespoke operation on your funding, I think you'll have a better outcome. I think you'll own more of the company. I think you would have the capacity to grow more rapidly and have a better experience when you're customizing it and not living in a world where we've lived in the last 65 years, which is basically kind of a one-stop shop. So 506C, public solicitation, very few rules around it. You can fundraise almost as much as you want. You can only take accredited investors. There's one more filing that you have to do, and it's very simple. Ideal for companies that are going out to a where their customers are also of that sophisticated accredited market. So if you're putting out a product where the impact customers are physicians, and you can create a really interesting, unique way to capture that market and bring your customers in as your investors early on. Some really interesting things out there. The other thing is that even though you can only take accrediteds by doing public solicitation, everyone knows what you're doing. So you do have to, and people like myself, my platform actually will check for do third-party validation on all of those, but the world can find out what you're doing. And so for companies where it's important or it's a competitive advantage for lots of people to know, then it's really something to look at. And that's why some 8,000 companies today have done a public solicitation, a 506C. And I just, in preparing for this, I just talked to one of the attorneys that is on the SEC advisory board for the Jobs Act. And he told me that the SEC had told him that although they've had a handful of investigations, that they generally are happy with how 506C is going. Now, there are attorneys, there are law firms here that are within 2 or 3 miles of here that will not represent a company doing 506c. So I would say, I believe in the next 2 to 3 years, 506c will be the standard. That we really will move away from totally private solicitation. I think where we will be doing private is if putting information out about the company is so highly sensitive because of the competitive nature of it that you just can't take a chance of having any information out. So I think that would be the reason not to do it. The other is if it's highly sophisticated. So I actually personally do investments in pharma because that's the space that I come out of years ago. But big pharma, complex kinds of medical kinds of things, there's no reason to ever do early public solicitation because the average person will never understand it.
So what's the reason why the law firms won't do a 506c?
Because it's way new, and there's not been enough history that they believe that it's worth the risk. And one of the risks that would be out there is if somebody, so you do need to validate and make sure everyone in your group is accredited. So if somebody lies and they say that you convinced them to go in, you knew they weren't actually accredited, they could actually come in, ask for their money back, and once that happens, it kind of opens it up, and you have to actually research that everybody actually, honestly, is third-party validated. So it's just to make sure that process is clear. The other one I think that, and at the same time, so let me just toss out just a little bit about this. Does any people know about Reg A plus? Have you talked to any about Reg A plus? Reg A plus is the newest regulations that have just come out from the SEC. Those are going to be going into effect sometime in the next 30 days. They call it IPO light. And this is really an ability to go out. Again, it looks like public solicitation. It looks very much like an IPO. Non-accredited people can also invest. There are 2 pieces of this. One is up to $5 million that you can raise. The other is up to $50 million, so there's kind of 2 ways to do it. Up to $5 million, you have to follow blue sky regulations, which I won't get into a lot of that unless you'd like to. But what does an IPO cost today? Does anybody have any ideas on it? What's it cost for an IPO? To actually do it, it probably cost about somewhere between $300,000 and $400,000 for the roadshow, and then probably maybe $150,000, I think, $150,000, $200,000 a year. So it could be up to $5 million if you look at it over the long term. So a Reg A plus, they're estimating that it will cost maybe $50,000, $50,000 to $60,000 up front. And you're not actually a public company, so you can always go back and do private deals or anything like that. So anyway, that's going to be in the next 30 days. And again, you have your public solicitation. So all those things are happening. And do we need to talk about crowdfunding at all? You kind of have to at least know those kinds of parts. But I'll tell you that the piece that I think is most exciting in that is not really all the regulations and all the rules, but the real opportunity with what we call crowdfunding and refer to as crowdfunding and equity crowdfunding is that we are creating new models. We're creating new partnerships. We're bringing in new people, and we're creating new products as we're doing this. So AngelList is really a better, cheaper, faster. AngelList, the people that are investing on AngelList are people that have invested mostly in Silicon Valley. I think it's very much a profile of a Silicon Valley investor. It's just that they're making it a little simpler to do. They're taking a lot of the legal work is standard. You can DocuSign everything. You can pull it together in a syndicate. So a lot of that baseline is better, cheaper, faster. What's the really amazing kind of piece of this is some of these really interesting syndicates. that they're putting together. I believe the two most brilliant VCs in this space right now are probably Brad Feld and Fred Wilson. Interesting, Brad Feld and Fred Wilson, neither one are Silicon Valley located. And I think, I hate the fact that this is being videotaped when I say this, but I think there's a benefit sometimes of being outside of Silicon Valley because it may be easier to see the shifts in your own model. Brad, is in Boulder. Fred's in New York. Fred's probably backed more collaborative investing or crowdfunding types of companies. Brad has, I think he's now raising his fourth FG Angels fund. So Brad has his own fund. He has an angel syndicate where people can choose to come in behind his investments, and now he has an angel fund on his fourth fund. And that fund, and those are all different models. That fund is a pre-investing. You're authorizing him, but it's a very unique kind of hybrid of a fund. So they're really testing the boundaries on this. They're testing the boundaries on the legal documentation they're putting together. They're testing the boundaries on the relationships. If you look at Brad's FG Angel Fund proposal or a PPO, he's talking about that it's as much about building a new community, it's as much about training new investors as it is about returns. So really interesting kinds of ways that they're looking at this. On Portfolia, we have created, and this is, I need to be careful about how much I can say on this because again, depending on what the regulations are, you have to be careful, but I'll tell you as much as I can. We have created what we're calling a Learn by Doing Angel Fund with a major foundation. That angel fund has 9 lead and very experienced angels. They are the GPs of the angel fund. They take half of the carry, 10%. 1% on the whole deal, 1% on the whole fund, 1% on the deal they do. Behind them are 90 emerging angels that are coming in, small amount of money, $10,000. All of the money will be invested in the first year in 6 to 9 deals. During this first year, they can listen in and watch and view and learn from what those 9 senior angels do, see the kind of questions, listen into their back discussions, see all the diligence, go to quarterly training, and at the end of 1 year, they walk away with 6 to 9, little tiny pieces of 6 to 9 companies. And so a little portfolio from their learning program and basically launches on how to become an angel investor. The idea then is that 99 blossoms and splits, and it's basically a scaling model to bring in new investors. In our case, very wealthy women, very sophisticated, a lot of them in Silicon Valley that have never ever invested but have every capacity to do it. But it lets you dip your toe in the water. Doing the same thing with minority funds and with others that actually are going to start shifting what we see and who we define as angel investors. Another interesting kind of model that's out there that we're doing as well is innovation funds. So I just signed the papers last night at midnight, a Fortune 100 corporation who wants to be connected to those that are doing innovation in the active aging space. So they have contracted with us and basically contracted with us for a certain amount of money. They're not a GP, so very unusual. They're not a GP. For us to take that money and invest it in active aging companies at the earliest stages. And it will be an evergreen fund. So whatever money is made on it, we take our cut and it keeps going back in and being reinvested. So rather than they're starting their own venture fund, they have that same kind of relationship as you would have, but they have none of the administration, none of the work, none of the risk, none of the negatives, that could come out of that. So, another kind of way to do this. So these are the kind of models that are coming out. Specialty micro funds in certain industries, specific kinds of training funds, FG angels, and we're going to see more and more and more of these, where we're basically turning what has been venture capital and angel investing into an asset class that individuals get into, that family offices get into directly, that corporations move into, and it's really never been done before. So that's just one piece of it, and there are many, 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 many others of these out there. So one more or less final thing, and then I'm going to open it up. But when we're looking at this, so I have a company right now that I've helped think through what their financing strategy is. So when we talk about a bespoke strategy, so this company does happen to be in a very early stage in the aging space. Interesting team out of Johns Hopkins. Physicians will be a major influencer on their growth, on their viral growth. But the company, the product will also be sold directly to consumers. So so what we've determined was the best first way to move into this is go out for non-dilutive money on the consumer side. So a Kickstarter, where they've done very, very well. Some really interesting, great signaling, takes nothing out, of the company, get some early kind of traction. They go directly in to the consumer market with that. They have a National Science Foundation SBIR grant, completely non-dilutive, moves them up at a much higher level, and you can get up to $1.5 million, over the first 3 phases of the National Science Foundation. I'm on their SBIR board. but anyway, so that, and what does that do? That opens them up to the professional community. So now we have consumer, we have professional, we have some significant money, there's been no dilution. Put them up on Portfolia, doing a public solicitation, but we're going out to those physicians directly now. Those that have already heard about the company, kind of in the back is something really new and kind of innovative. So we can target with a public solicitation, it's open to the public, but you don't have to take people's money. So what we want are the physicians that have the largest practice in this elderly population. They're the ones that everybody looks to. They're the opinion leaders. And if they believe in this, everyone will move in. And so we target those to come in as investors. Now, let me tell you, there is no one on Sand Hill Road that will be as effective in this space as those individual doctors at this level. Now, they may be putting in $10,000 or $15,000 or $20,000, but the traction and the reputation that they can bring is almost priceless. So again, and the issue of valuations are not as sensitive as if we were talking to one of the VCs about this. So, we're already building up already the kind of personalized, designed, let me just say that, not personalized, but designed kind of funding strategy. Now, we're going to add in our some financing from our strategic micro fund that's in the active agent space. And oh, by the way, that company does $20 million of data research in the agent space a year. They make that available for free. They also own the aging space in Target, CVS, Walgreens, and Walmart. And they'll actually help us in those channels if we want. So we've created the ability for a juggernaut here before we've actually even been out to the venture world. So by the time we go out to the venture world, because we know, back to what you were asking me about, because we know what our market is, and we're coming in with this big head of steam, the valuation, the negotiations, the ability to get a really top VC on our board, the whole pitch has shifted. And so that's the kind of thing that we're going to be looking at. Now, it would be also very interesting because, so let's say we get a great big, nice, wonderful VC in this, and Richard Schwartz from Berkeley just told me that 73% of people that do equity crowdfunding rounds that raise over $100,000 will receive a term sheet within 6 months of finalizing that fundraise. So an interesting signal that happens on this. Now, so you've had a round of money, and you're going out for, let's say, a C or D round. That's when I think Section A plus, or when Reg A plus is very interesting, because usually you don't have a lot of competition. I mean, there's a lot of people that are out there, but what Reg A plus does is starts to balance out that opportunity. You can do a mini IPO, or you can take venture money, or you can take, later stage growth capital. So it just gives you that much more opportunity. Now, I think probably later stage venture money is the way to go, but it gives you choices. And anytime, as we know in a marketplace where you have choices, then it gives you more opportunity, to find the right options ahead. So that's the kinds of things that we're looking at. That's the kind of future, I think. And that's only the beginning. Those are just the second, like I say, the secondary markets. Letting angels be able to have a little bit of liquidity in this is going to open up so many more amounts of money. The hedge funds are circling around this whole space, as are many of the other major financial players around the country. And so what I would leave you with this is not about Kickstarter, and it's not really about AngelList. It is about a complete opening and disrupting. I want to say disrupt. It's a complete enhancing of a market, of a process that is integral to everything that we do as entrepreneurs. It's all about finding the fuel. And what I believe we're going to see in the next 10 years is massive new ways to fuel our companies. And it's in ways we've never even dreamed of at this point.
So I have a question. I'll start off with
Yes.
questions. So from a long-term perspective, we see a lot of successful venture capitalists might come in through multiple different routes. Either they were former entrepreneurs, someone like David Hornick was a former lawyer, and then there's also a group who were formal angel investors. Do you think that with the rise of number of angel investors, we'll see subsequent shifts in the model and the makeup of venture capitalists in the future?
Absolutely. And we're already seeing it. I mean, we're seeing, that whole, and I think you talked about this earlier, some of you, but, the archangels that are now micro VCs, that are shifting. Angel groups, nearly all the angel groups are on platforms. And, a lot of what I do at Portfolia is I aggregate angel groups. So we have 28 angel groups now that we're working with. So that idea of angels, the idea of angels and VCs investing in a geography is another one of those things that's going away because of that sharing of information. So that's shifting. One thing that I think is going to be really, really interesting is how women use this. And we're seeing a number of women, very high-level women, VCs, that are actually moving out of their big venture firms and leading syndicates, almost search funds or micro funds. So we're really going to see major shifts with this. And then I think one that I haven't touched on at all, understanding this big, is family offices are the core of small venture funds. That's where they don't, small venture funds when they're starting, they're not getting big foundations. They're not getting pension funds. It's family offices. And what we're already seeing is a number of family offices are going in, starting to invest directly through a lot of the platforms. So that's going to shift the venture and the angel space. Yes.
You mentioned NSF and SBR grants as a source of non-dilutive funding. I'm curious, does Portfolia offer any sort of advice to startups in getting those grants?
So we don't, but we do refer people to groups that do help them, assist them in getting funding. And there's a large network of people that are very helpful to grant, and help write grants and understand how to work that. And as you may know, Steve Blank does I-Corps. I think he does it out of Stanford. I-Corps, which works with entrepreneurs to get them prepped for applying for NSF funds. The problem with NSF funds, and actually the big meeting is next week in Atlanta, is that it's usually 6 to 12 months out. So it can't be, again, it can't be it's just part of the layering on a strategy.
Understood. Another question, so you mentioned these learning angels that work with Portfolia. Are they invited or do they apply and then they're evaluated for?
The nine basically have to provide us information about the numbers of deals they do, their exits, because oftentimes platforms forget that it really isn't about how much investment goes into a company, it's really about the exits. And so we look at all of that, and this is our first one. So this will be a pilot, and we'll look at what works and what doesn't. This is a general fund, and we'll probably do specialty funds as we move forward, but as a first one, it's a general fund. Yes?
What are the qualifiers for the people who, I guess it's the micro funds, like that you said $10,000, small investors, small, tiny, but what are the qualifiers to get into that process?
You have to be accredited as so that's the big thing right now, is that you do understand that Title III is not legal, so there is no non-accredited, so what was called Title III in the Jobs Act, there's no non-accredited crowdfunding. Reg A plus will allow non-accredited in these IPO lights. It gets very confusing, but there is no non-accredited, so they do have to be accredited. And in this one, the first fund that we're doing, the Learn by Doing fund, is for women, but we're doing subsequent funds that are open to anyone. Almost all platforms today are 90% men. Angels are far and away male, about average of late 40s. So what I'm actually doing is really looking, women now own in the US, interesting, 51% of the personal investable assets. Happened a couple months ago, first time in recorded history in the US. So if we don't unlock women as investors, when they own half of all the investable assets, then we're going to have some challenges ahead. So, that's one thing that we're looking at, is how we tap in. And I think we're going to see different kinds of companies that are formed. I think it's going to be a really interesting new way of investing and the ways they invest. But we're going through a lot of massive shifts in the venture world, but just besides this regulations, the kind of companies, 20 years ago when I started Kaufman Fellows, 21 years ago, we didn't even have a consumer category. There were so few venture firms doing any kind of consumer facing. It just didn't exist, and didn't for most of the 65-year history of venture capital. So there's a lot of shifts happening. And the industry itself sometimes isn't keeping up with a lot of those shifts. So.
Yeah, and I think also the bar for being an accredited investor is also shifting. So you probably know this better, but after you have at least $1 million in assets, not including your house mortgage, and then also, or if you have just $200K in annual income. So.
That's right, and it's up now under under definition to Ernestine on this, and what they're looking at is probably moving that $1 million up. But they're also looking at adding a new category of sophisticated. Sophisticated's out there now, but it's not defined. And so it's really, we have to be careful with it, because without the definition, that could really get you into trouble. Now they're looking at defining it really tightly, so that, a number of you in here may not be accredited, but certainly you're sophisticated by virtue of your education and your experience and things like this. And so it's going to shift that so that it's really not about wealth, or wealth will still be there. And the wealth thing is just that you can afford to lose. But there is a sophistication level that says this person has a baseline smarts, experience, knowledge that they should be able to invest. Because today you can invest nothing legally. Now, friends and family, there isn't, they turn a blind eye. But you can really can't invest legally in companies if you're not accredited.
So next question, I guess. So these crowdsourcing platforms are relatively new, whereas you're comparing the venture capital world, you know, we have data over the last 60, 65 years about what returns have looked like. What, I guess, question one is, what have the returns been, if we have any, on these crowdsourced raises? And also, is that something that worries you, is people putting in their money? They might be sophisticated, but they might not have the capital to lose, and they're putting that at risk potentially.
So, so right now, you know, I don't know that I'll ever move from an accredited platform, because I have so much. I mean, with a subtle focus on women, there are 5 million women, and only 20,000 that are accredited. Only 20,000 have ever invested. So I have a gigantic market that I can, you know, continue to focus on. So there's a number of ways I would address this. I would say, number one, if you haven't seen a few years, we are in a bubble today in Silicon Valley. We are in a bubble right here, and we're in a larger bubble. But overall, the industry-wide returns of venture capital are not, would cause us to think that model needs to really be reconsidered. If you've not read the Kaufman Foundation's report, I think it was called I Have Seen the Enemy, and It Is Us in Venture Capital, something like this, that looked at the returns in venture capital for 40 years. There are some huge problems in venture capital that have happened over the last 20 years. So we need to rethink the model when only 20 of the 500 have successful exits. Would be, you know, one thing that I would, you know, look at that. The other is that in the U.S. it's not been long enough. Crowdfunding platforms, as we know them, have only been around for about 2.5 years. Indiegogo and Kickstarter have been around a lot longer, but that's not really a good comparison data, you know, because those are $25 contributions. Where equity crowdfunding has been around the longest is in Australia. It's been around 9 to 10 years now, and throughout Europe. Most of the studies have been around whether or not fraud is an issue, because that's what the US and the SEC is most concerned about. The SEC is not concerned about whether or not you make money. The SEC is worried about whether you will be a victim of fraud. And so when they talk about this, and the reason we have some of the most strenuous regulations in the world, and they'll say because of widows and orphans. So that's really the big issue, you know, that we're facing, you know, that we all face. It's not return. With regulation. It's still too early to tell. It's still too early. VCs, even what VCs do in Europe, are not what we would consider venture capital. What they invest in is not what we would consider angel. It's more local, you know, companies. And for local, they don't lose money, and they make returns that would be more bank returns. So it looks more like lending. It's basically what we know for now. My big concern is that there are probably about 100 to 200, some people say there are 1,000 platforms out there. There are a lot of them, like in the venture world, that shouldn't be out there. And I would prefer that non-accredited investing doesn't happen for 4 or 5 years until the accredited piece gets settled. I do like sophisticated. I do like the idea of sophisticated. And like how they're defining it, but I would not like to see just completely regulations going by the wayside. I think it'd be dangerous for all of us.
So just since you brought up the Kaufman report, the one you were mentioning, so it says in the report all these problems the VC industry has because of misaligned incentives, like the 2 and 20 structure,
Right.
and the fact that they want to raise a next fund, and therefore they invest in things that the LPs otherwise could have invested directly themselves and whatnot. So do you think, despite of all these misalignment of incentives, that there's still money going to the VC industry because the top half of the VC industry is still performing that much better? Or do you think there are other reasons why, despite the obvious, again, misalignment of incentives, money is still being put into VC at an unprecedented rate, basically?
Well, I'm really, you know, as you know, someone that you know, was completely committed to the venture industry for 12 years. I ran Kaufman Fellows. I'm glad to see where we're at right now. I mean, but what we know is VC is a heavily cyclical business, and we are booming right now, and the returns are out of this world. And those of us that have been around for 20-some years have seen these kinds of things happen. And what I hope is that this is the one that will be different. But what you see is great ups and downs with that, and people, scram from the market, as soon as things start to turn. This would be, I'll just toss. This is not based on research. This is just my own bias. But I think if we had more than 3% of the GPs women, that we would not have as many of the wild swings. I think potentially that the industry would balance a little bit. Because what we see in other areas of finance are that there's some interest. It's very early, but I would say there's some really interesting research coming out of Berkeley right now and a couple of other places, but Berkeley especially, which has done deep analysis of men and women as they invest in banking and hedge funds. And there is, what they are documenting is much more likely to have the booms and busts, much more likely to have lemming behavior. I'll tell you so one of the interesting things that has come out of this, and they're replicating it now, and some of my researcher friends are involved with this, is that when men are watching other men invest, when men invest and other people are watching them, which is the venture world defined, they make riskier bets and invest much higher amounts of money. There is no comparable activity by women. So women invest the same way, whether people are watching them or not. And so there's a lot of different things that, Berkeley is positing are, come from long ways of how we behave and has to do with our endocrine systems and all kinds of things like this. But what some of the early materials are coming out is saying that the more balanced you have in gender, the less likely you are to have major swings and boom and bust cycles. So I'm really looking forward to seeing some of that over the next 4 or 5 years, and looking at it, because there are, again, I worked in the venture space for a long time, and 25% of Kaufman Fellows are women. But it was because we went out and found the best of the best of the best and put in front of our venture partners. But there is no other industry or no other institution worse than the venture capital world except for the Roman Catholic Church. And that's the truth. So we have to change this, and I think that a lot of venture capitalists are realizing this and looking to make some changes. This is not a healthy model. And so on this, the issues of putting in 1% and getting 20, there's a lot of things like that. But if it's the only game in town, Kaufman Foundation is back in venture capital in a big way. So you want to have your asset class, big foundations, pension funds, all of us, we want to be in the asset class. But it does have a lot of challenges long term, over time. We need to move to our.
I was hoping before we move to that, can you talk a little bit about just how you started the Kaufman Fellows program, since that disrupted the entire venture capital model, and
Yes.
That's one major disruption that you.
Yes. So I think the venture capital world is so exciting to look at, and believe it or not, I'm a huge proponent of great VCs and think there's so many great VCs that came through Kaufman Fellows. I'm a little biased there. But venture capital was wealthy families. Started in the late 40s right after World War II, early 50s, Venrock, the Rockefeller families, Whitney, Morgan Thaler's. And then in 78 was when it really started to move from families into a professionalized space. And then in the early 90s, what we started to see, but it was still, a very, very much a cottage industry is how VCs would talk about it. And in 1994, when we just were looking at what we were going to do with Kaufman Foundation, the average age of a VC was 56 years old in 1994. Average age, 56 years old. It's very different than it is today. Ewing Kauffman, big entrepreneur, never took venture money, sold Marion Laboratories for $6.5 billion in 1985. It's real money back then. He still owned them, had a majority interest in it. He decided to put the majority of his wealth into a foundation to support entrepreneurship. That's how the Kaufman Foundation came about, 93, 94. The IRS took 18 months to decide whether or not this was a scheme because no one had ever, no foundation and very few people, no universities, really spent any time or had a focus on entrepreneurship. So after 18 months, they decided to give us 5 years, give us a test to do this. And so it was a wide open, talk about a greenfield. And so we had $100 million a year. We went from a $250,000 budget to $100 million a year budget to support entrepreneurship because you have to invest 5% of your corpus. And I think it's one of the most interesting things that a board of directors has ever done, high risk. They could have started at the very, very bottom of entrepreneurship, and they said, if we, to really, really make a difference and shift what's happening in entrepreneurship, we need to go directly to the most sophisticated area in the entrepreneurial world. And let's look at how you create a new cadre of leaders in venture capital. Because it was moving from, in the 90s, to, instead of being bankers, people moving down, the investment banking chain. It was really time, there was gigantic technology coming out in health and digital, of course, technology. And so we partnered with 20 of the top venture capital firms, everyone from, Venrock to USVP to Draper Fisher to, the top people that were out there, and basically created this from nothing. So interviewed over 100 VCs to find out what makes a great VC. Basically our attempt was to try to crack the DNA and figure it out. And created a 2-year, high-intensive program where you basically were a full-time partner track VC, and you got together 4 times a year to learn the venture world, and everyone had a mentor. So we, over a couple of years, built out one of the top education and leadership program for VCs. So we had firms, there still are, NEA at one point had, I think 6 of their 9 young partners were all Kaufman Fellows. Some of the very top firms used all of our material, even for people that didn't come in through the Fellows program. So it's very, very exciting. And we spun out after 12 years as an independent organization. They're here in Palo Alto, just about a mile away from here. So that was the beginning. And in an entrepreneurial move, we actually created our own venture capital fund of funds to underwrite the nonprofit Kaufman Fellow. And after 12 years, I left and went over to run the holding company for the fund of funds. And it's now $1.2 billion VC fund of funds that we own 50% of the partnership that underwrites the global growth of Kaufman Fellows.
For more, please visit us at stanford.edu.